another episode of Unlocking California Politics. I'm your host, Sanjay Wagle, and today we're getting a view of what's ahead for the California housing market. We are joined today by a returning guest of this podcast, Jordan Levine, C.A.R. Senior Vice President and Chief Economist. Jordan joins us to discuss the 2025 housing forecast and what it means for both realtors and Californians across the state. Welcome back, Jordan.
Thank you so much for having me back.
Jordan, housing remains at the top of Californians' minds, and I think all of the United States at this point, whether they're buyers, sellers, or just trying to make sense of the market. We have a lot going on right now in the economy and California. We've had major fires in the Los Angeles area. On the national level, we have tariffs, a new spending and tax bill pending, and it looks like inflation is still around, and not just for eggs. CAR's original forecast for this year was fairly positive, with sales increasing 10.5% and home prices climbing 4.6%. But given the current environment of change, both in DC and in California due to natural disasters, et cetera, is this still the forecast, or is there more variability, would you say, in terms of what the year looks like?
Yeah, you got me. You busted me. We've recently had to downgrade the forecast. We're still optimistic that things are going to go up. And actually, we even started going up a bit last year as well. But the pace of progress is just painfully slow. And just when we think we're kind of out of the woods on some of these crazy wild cards, like you said, we get the fires, we have policy changes that actually could be substantive in terms of not just macro, but also specific impacts for housing, and so we've tempered our optimism a little bit. We went from about 10% up this year to about 5.5-6%. So that ultimately leaves us still below 300,000 units for the year, when we originally were hoping we'd get up above that 300,000 unit mark. Not much above, but 310 makes a big difference. And so, yeah, I think that's looking more and more like the kind of better or best case scenario, and 5.5 is probably a little bit more realistic. That kind of enables us, or allows for a couple of quarters that are weak or maybe even negative on the macro front, but not kind of devastating economically. That being said, we started kind of doing ranges and scenarios instead of just coming out with a straight up number. And I think that is just a testament to how variable and volatile and the effects of all the uncertainty and things like that, which I think will probably persist at least for a little bit.
Right. I spoke to some of our colleagues who went to an economics conference in uh, earlier this year, and they said it was the first time almost nobody was willing to lay out a prediction because everything was so kind of in flux right now. And many of them had put out predictions even in December as to what they thought the year would look like. You mentioned some of the macro factors that maybe have pushed your projections downward. What are some of those?
Yeah, the inflation one, I think, February, it started moving back in the right direction again for the first time. But that is the first time in a handful of months where the headline number had kind of either been flat or even trending up a little bit. And to me, that just kind of says that we're not going to get the deep rate cuts that a lot of folks were hoping for. We'll probably get the ones the Fed told us that we were going to get, which is two minimal ones. And I think that's probably why they reaffirmed that, yesterday as we sit here recording this today. And there wasn't much movement one way or another in the bond market and the stock market. And that was more or less what was expected. But I think the hope has still been that we're going to still get big, deep, precipitous cuts. And I think when you look at the inflation numbers and the kind of underlying reasons why inflation's not going away, we still have a very tight labor market, and that hasn't really changed. We're in low single digits for unemployment. California is doing a little bit worse than the rest of the nation, but even here we're talking about 5-ish%. So more or less full employment. That makes it hard for inflation to go away all the way, and for the Fed to give us those deep rate cuts. And then the other one, which is somewhat tied, but I'm worried about the stock market. We've seen a lot of volatility in the last couple of weeks. And when you look at valuations and then you hold them up next to, earnings or profits are actually pretty healthy, but they're not so healthy that it's justifying these big valuations. And I think when you throw in some shocks or uncertainty or, tariffs and things like that, that it, not only is that going to hurt in terms of the fight against inflation, right? When we put, extra taxes on stuff that we're bringing in from overseas, that obviously raises retail prices. But I think it spooks financial markets, and in California in particular, it's not just the macro impact of the stock market. I mean, we're a really capital gains heavy housing market, right? That's why all those bills that we're pursuing at the federal level are so important, just because when the stock market's good, it really helps housing here, right? And you got folks that are leaning on those assets or cashing in stock options or even just feeling richer, right? And they feel comfortable going out and buying a bigger home. And I think that could be one of those, things that we got to watch out for. You never know what's going to cause the stock market to, face a more sustained correction. But I think that we're vulnerable there just because of how high these valuations are. And then I think the third big risk factor is consumers. We consumers have always been the biggest part of our economy, but since the pandemic, consumer spending is really the thing that's kind of taken us out of those depths. And I think consumers are running out of gas. If you look at how we've been fueling this growth, especially over the last year and a half, we did get, big increases in incomes and things like
Mhm.
that. But we've spent through all those raises and we're increasingly putting the money on the credit card. And, one would think that that would eventually have to come to an end, or it's going to, precipitate a bigger issue down the road if we don't get our kind of financial houses in order. And so I think to me, those are the big three. And then maybe the wild card that I'd throw in as a fourth would be commercial real estate, and office is still having a tough time. So
So a couple of things there. You mentioned consumer. I think recently there have been the consumer confidence index, not a record low, but it has not been so low in quite a while. And also you mentioned the stock market as an impact on housing. Is it just the capital, that people would sell stocks for to maybe down payments or whatever, or is that also just a feeling, oh, my 401k balance is going on? So if you could talk about both the consumer confidence, how that might be affecting everything in terms of the economy and also about the stock market and housing.
yeah, they're like deeply connected. The econ nerds call it the wealth effect, but there's the psychological component of just when I feel like my retirement's safe, right? And that I won't have to work till I'm 85 years old, then
Right.
I feel comfortable upgrading. And maybe the opposite is true, right? Even though I've had a couple of kids and maybe my house is too small, if my stocks are looking terrible or my company isn't valued as high and I'm worried that maybe there'll be cutbacks or things like that. So I think there's both the kind of real honest to goodness balance sheet aspect of, hey, I'm worth more money. But I also think there's that kind of consumer behavior component to it as well. And you mentioned in the consumer confidence stuff that it takes a hit when gas prices are high, when we're not feeling as rich, than even basic consumer spending, right? Like I maybe try and limit myself to $100 at Costco kind of a thing. I think that's all very real. And it's not just the kind of public zeitgeist. In fact, if you look at the most recent retail spending numbers, it corroborates some of this lost momentum or folks losing their mojo in terms of just consumer confidence. Because although we've been growing and people have been spending increasing amounts, it seems like that's starting to peter out a little bit. And I think that's both the inflationary chickens are coming home to roost in a way where we've
Right.
been grappling with all these higher prices and everything's been costing more to begin with. But then also that kind of running out of gas piece where it's just we're reaching the upper bounds of how much we have to spend.
Yeah, as you mentioned, the chickens are coming home to roost at my son's school. They have an auction as a fundraiser, and they actually started, on a humorous note, but it did, I think, get them about $125 auctioning off a dozen eggs as
Yeah.
part of let's start off with the most valuable commodity.
No, it's insane. It's a real life thing. I'm on a health kick, so I'm trying to eat healthier, but my kid wanted to go to Taco Bell the other day and I remember 59.79.99, but it cost us almost $40 just to drive through Taco Bell. So it's a real thing.
Um, Getting into a specific reason for, inventory is still low overall, and one of the reasons for that, uh, is what I think people are calling it kind of a lock-in effect, a practical lock-in effect, not an actual lock-in effect of the fact that so many people have historically low, enjoyed mortgages at historically low interest rates. Couple of things. How strong is that effect? And also, don't you still get people eventually selling because they need to move, get divorced, move on with their lives, downsize, or will they end up just keeping them as rentals? I mean, what are we seeing in that front?
Yeah, I think all of the above. You're kind of speaking my language. On the one hand, we have the lock-in effect, which is, very much alive. Well, I always joke I'm the son of a guy who used to brag about a 12% mortgage back in the day because that was cheap at the time when he got his. But I mean, we hit, all-time low levels during that pandemic, both because the Fed cut the Fed funds rate to zero, plus they were out buying a ton of mortgage-backed securities in the open market and pushing down those long-term rates. And people, got in at a really cheap cost of debt that we really never you can't even get a car at 3%
Right.
anymore, it seems like.
Mhm.
And what that has done is it makes moving a pretty severe financial penalty. You even if you buy the same exact priced home at a 6.5% rate compared to 3.5, that payment's a lot higher. And so the kind of financial incentive, that's a very precious commodity, that 3% mortgage. And so if you have the wherewithal to hang on to that forever, even if that house doesn't work and you can come up with a down payment to get to your next house, it makes sense to hold on to that. And I think at the most recent, this is quarterly data, so we only know really through the end of the year. But I think as of the end of the year, you had 2/3 of California mortgages that were at or below 4%. Those folks are, facing pretty
Wait, what
stiff.
was that number again?
It's about 2/3 that are at
Yeah,
or
that's a
below
lot.
4%.
Hmm.
So, you're talking about 2 out of 3. That's a big chunk. But at the same time, the kind of financial incentives are only one piece of it. And sometimes you gotta move anyway. Like you said, you get divorced, you've had kids, the pandemic started, we're coming up on 5 years ago now, and people have had kids since then. They've gotten married, they've gotten divorced, and it doesn't matter how sweet your interest rate is. If you've had 3 kids in the last handful of years and
Right.
you're in a two-bedroom condo, you gotta dump the house, right? And so we are seeing more inventory come online, and that's actually one of the reasons why we have the growth in sales forecast that we do. Is demand hasn't been killed off so much by these rates. It's actually supply that's been the limiting factor, and that will enable us to get more transactions. But I think the backdrop too of that is we should get used to low levels of supply. Like I don't think it's going to ever increase back to what we used to think was normal. 6, 7 months of supply on the market was a normal quote unquote market. And I think, we'll go back up from the lows of 1.5 months of supply, probably to 3.5. But that's probably the high watermark, just because unless you really do have to move, you're going to try and hang on to that mortgage. And I think that's why people are still renting. And I know you brought up the rental stuff. As hostile as we are to the rental environment, right? The landlords are looking at the underlying appreciation, and in some ways, because we're so hostile, no one wants to build anymore either, meaning that the
Mhm.
existing real estate only
Sure.
becomes even more scarce and valuable. So
Well, on that happy note, no, just kidding. But on the investor side of things, we have historic levels of institutional ownership of homes in California and throughout the country. The low interest rates at the time did tempt a lot of smaller investors to get in. Based on what you're saying, it sounds like most of them would probably decide to stick with their properties. But do you see some investors or some of the larger investors unloading these properties? Or, as interest rates in other areas or other investments become more attractive? Or do you think there's not going to be much effect there?
yeah, over the short run, I'm not super optimistic. I think, there's a whole range of appetites for risk, and some people just don't have the stomach for, or just don't have the desire to kind of suffer through this hostile kind of landlord environment that we have. And
Right.
that's just, a kind of bridge too far for folks that will choose to,
That's
dump
true.
them with the restrictions and things like that. But, we actually see in aggregate the investment activities going up. You've got all these
Huh.
home buyers that are kind of sitting on the sidelines trying to time the interest rate and get that perfect intersection between maybe prices go down, which we don't think is going to happen, and rates that will also come down, which we also don't think is going to happen. But if you look at the investors, they're banking on the long term and still buying real estate. And I think one of the weird things about this potential cycle that we may be going through is that when there's concerns about the stock market, it tends to make real estate more attractive because,
That's
you just
true.
park it there to kind of as a safe haven to avoid any Wall Street shenanigans. And both because of the long-term just housing shortage, price appreciation potential, plus, concerns about what would happen to your money if you left it somewhere else, that I just don't expect that to be the saving grace for supply. I think more so we'll just see people who have to move because life stuff.
Yeah, that makes sense. Kind of what you're saying earlier about the stock market and how valuations are high. There's a lot of potential. Like basically everything would have to almost go perfectly for everything to sustain. Yeah, so there's probably higher risk there in terms of where you're going to put your money. That makes sense. Um, so median prices have climbed, I believe, to 909, and
Yeah.
affordability still stuck at 16%. I do a lot of things with our National Association of Realtors and my counterparts in other state organizations, and whenever I mention our prices, they're like, "Oh my god." Like, it's not ever even fathomable. But, how far are we from a $1 million median home price in the state of California?
We're probably only a couple of years out, so we have some pretty solid growth, over the next couple of years, and we don't quite reach it by the end of our 3-year range in '27, but, barring some pretty brutal, unforeseen economic consequences, I think we'll be there before we hit 2030, and we'll be $1 million median price state. It's funny. I travel around the state talking to our local associations all over the place. And I just did an outreach in Fresno. And I think, the median price is in excess of 500,000, even in our most affordable markets, and a huge sliver of even places like the Central Valley have
Right.
entry levels at 6, 7, 800,000, and you go tell people in the rest of, to somebody from San Francisco that's looking at a tiny condo for 2 million, that's still affordable. But like you said, you go anywhere else in the state and you tell them the entry level is 6, 700,000, and they're, very shocked by that. And it's, yeah. And I think it speaks to why people still buy real estate here, because that shortage is just so dramatic that even with rates that have doubled faster than they ever have over the last couple of years, we still have prices that are going up.
Yeah, it's interesting. Yeah, I'm from originally from the LA area, and I still remember I've been in Sacramento area for about 9 years now, and I still remember going back to visit, and I was just sort of looking at some areas, and Riverside, San Bernardino area had always been, quote unquote, the affordable part for people from LA, and I was floored by their home prices. I had like mind blown that that was the cost of housing in the Inland Empire. It was just like, wow, I would never have seen that coming.
Yeah, even Sacramento, we're
Yeah.
in the process of selling our building, and I was like, "Oh, if we bought something in Sacramento, maybe I could get like a really cool condo." So then I like go on realtor.com, and it's like $1 million to live in downtown Sacramento. It's crazy.
Just go a couple of miles out. You'll be fine. It's still relatively affordable up here.
Good.
Um, so the most important thing that we've sort of been touching on for housing is interest rates. Yesterday, the Fed did talk about inflation as part of and normally in an inflationary environment, they would probably raise interest rates, but they also talked about lower growth and lower employment. Um, and I was reading that in their additional comments, in terms of they were like, "Well, if we're being conservative at all, we're more being conservative about the growth being where it is and the unemployment being where it is." Like, that doesn't sound like a great situation because it almost sounds like, "Okay, we're keeping interest rates low because even though we've got through inflation, the economy is weak."
Right.
Um, how does all of this, first of all, play out, do you think, this year in terms of the interest rates overall and, kind of the broader economy?
Yeah, I think that what they've told us, a couple of modest rate cuts is probably a best case. I think the upper end of the range for the Fed at, 3.5, it's currently at 4.5, so maybe 100 basis point improvement, is probably the best that we can hope for. And I think even more so when you kind of drill it down to the mortgage rate side, it's not just the Fed funds rate that matters. You've got the yield curves no longer inverted, so people
Oh,
aren't
okay.
as scared as they used to be, which means there's more premium on top of whatever that Fed funds rate is for us as borrowers. And you also, don't have the Fed out there buying mortgage-backed securities, so spreads are probably going to be high. But this all just to say that I think probably 6% about as low as rates can go, in that
Okay.
kind of an environment. We're forecasting that for the year we're going to be somewhere in the 6.5% percent range, and I think that's why we have downgrade part of the reason why we've had to downgrade our forecast. I still think we'll probably end up getting the cuts, and they kind of alluded to this in their statements yesterday that although inflation is still kind of hanging on and employment's
Mhm.
still pretty strong, there's also a new kind of dose of uncertainty out there that has impacted the stock markets and things like that that could, cool things off. And so I think we're still pretty much on track for what they told us they were going to do, but for different reasons. I do think that we're going to see some slower growth. Again, consumer spending already showed that
Right.
first indication of dialing back. And we really have all of our eggs in that one basket economically. The government's not ramping up spending. You don't have
Right.
businesses out there investing a ton. And so, that kind of more modest forecast that we have assumes that we're going to get some, flat or maybe even 1 or 2 quarters of modestly negative growth. And so,
Wow. Okay.
overall for the year, we still have the economy up, but just a bit. And I think that, the kind of moral of the story is that even if you look at all of our forecasts, the transaction number really can't get back to those 400,000s or what we used to think was normal, for a couple of years, even under pretty rosy assumptions.
Okay. So FHFA is also in the news. The new head is very close to the president. He's been making appointments to the board of Fannie Mae, someone who worked, for example, on the Doge project. And I think it worked at one of the Elon Musk companies as well. Things are moving fast within the administration and at Fannie. And apparently, while privatization, they indicated, is not the highest priority, what are we concerned about in terms of the GSEs? What do we want to make sure is there to keep the mortgage markets protected?
Yeah, I mean, the GSEs really still pretty much are the mortgage market. Home ownership is important, obviously, to us. We work for the realtors, but it's also critically important for the economy. It's a kind of pay now or pay later kind of a game. You either build your own wealth or you have to get taken care of down the road. And so that the concern is that that's still, an option. I mean, guys like my dad who didn't even graduate high school were able to become homeowners, have kids that go to college and, support themselves and all of that stuff. And I think with the intersection of supply being so tight and affordability having eroded, and even
Hmm.
though we're kind of leading on that front, affordability is, a bigger challenge all across the nation. And then now we're kind of layering on with some extra policy headwinds. And again, with the GSE taking a big step back or going away or becoming, totally
Yeah, it's
privatized,
a
I
little
think
scary. Yeah.
there's, mortgage availability is already really difficult, and that's with the biggest player still kind of running at full tilt. So the concern is that kind of American dream, that wealth building and all of the other stuff that goes along with it, just kind of continues to go out of reach for a lot of folks.
Yeah, and I think, it probably helps us, I think, as far as the GSEs, that housing has become now a national problem. I used to think, the whole "so goes California, so goes the rest of the nation" may have stopped, like, maybe we were becoming unique, but so goes California, so goes the rest of the nation in terms of affordability.
Yeah,
Um,
yeah, and actually, they're when we don't build enough, we have we're exporting resin. That's one of our biggest exports now is
Right.
folks to other states, and you go to places like Austin and Idaho and some of those big popular places where Californians have gone over a long time, and it just really kind of highlights how building enough and keeping up with all this amazing economic growth that we've had over the last couple of decades, like you got to accommodate that with the housing, and so
right.
we sneezed, but everybody else definitely did catch cold.
So I think you've captured my next question, which was gonna be, supply still the solution to, ultimately to our housing woes, both here and now the nation?
Yeah, I think not just to our housing woes. I think it's, part of the cure to the economic challenges. It's no picnic being an employer and being forced to pay these wages that would equate to a quality of life that people want. You've got a bottom line and all that stuff. And with housing costs, it's people are really kind of doing that calculus. And it's not that complicated of a problem, unfortunately, from an economic standpoint. It's not fancy econometrics. It's really
Right.
basic arithmetic. You have a state that In the 1970s, we were about 20 million people. Now we're about 40 million people. And yet, back then we used to build about 300,000 homes a year. Now we're lucky to do 100,000 permits. Probably a lot of that is actually replacement units. So it probably even
Right. That's
overstates
true.
how good of a job we're doing on building. And it's not just that we've doubled in size, but the quality of those jobs, the pay, right, and all of that stuff is through the roof. And you really don't have to look much farther than that to explain the $900,000 median home price, the soon to be $1 million median home price, the 18, 17, 16% of folks that can actually afford to buy a home, and all of the other negative outcomes. We've got one of the most overcrowded housing stocks out there. Once you adjust for housing costs, we've got the worst poverty rate, I think, in the nation. And it really is, it comes down to supply, and again, it's not a hard one to understand, but it's proving exceptionally difficult to solve. Even though we know what the answer is, it's trying to get that done that seems to be just really
I
elusive.
know. And now with even more and more strains in terms of building with the rebuilding efforts that's going to happen in Los Angeles and materials costs and everything else, it's going to be complicated in
Yeah.
the next couple of years.
And
Just
and
wanted
maybe it's an opportunity. We saw some changes to laws
That's
temporary,
true.
and we might wake up and realize that it's not as hard to get housing built as we thought it was.
Yeah, that's true because the governor's executive orders have streamlined some of the development in the Palisades and the Altadena area, and I agree. If we do see some significant results from that, I think that'll be a good, maybe a precursor to a broader reform effort. Um, Wanted to briefly talk about Proposition 33. As you know, the attempt to repeal Costa-Hawkins failed in every county in the state of California. Would that have changed our forecast if that had passed, which would have allowed rent control on single family homes?
I would have definitely gone back to the drawing board for sure. I mean, we just talked about the kind of number one biggest challenge that we face as a housing market, as a economy, and things like this. If you kind of zoom out and look at the big picture, and I'm not a lawyer, thankfully, so I'm always thinking about things at a 30,000 foot. But why would we want to disincentivize housing supply, which is ultimately the result of these kinds of things? And that's pretty
Right.
conclusive in that you know, even in the academic literature, it's not just the kind of professional economists out there. This is pretty conclusive, and I think that lost a big chunk of housing stock with the fires. We're already
Right, that's
so
true.
inventory constrained, and rental vacancies are super low. And I think that you um, penalize, or you take away the stuff for new housing in particular, which is that would have been like kind of the one thing that we're trying to get going, that would have just really exacerbated the stuff that we're already dealing with. So definitely wouldn't have been good. I can't give you, I didn't crunch the numbers, but we would have been more pessimistic.
Yeah, and I think it is a message that even for Californians, some of whom might support some of those rental restrictions, um, sort of saw the potential adverse impacts on housing. Otherwise, we wouldn't have seen such of, I think, a repudiation of the whole concept throughout the state.
Yeah, I mean, the deal is we got to attack the causes, not the symptoms. Housing's not
Right.
affordable, but let's address that.
Before we start to come to a conclusion, what sort of practical advice would you give to our realtors helping to navigate the market in the next year or two?
Yeah, I think, kind of confronting fiction with fact is a big one. There's a lot of kind of opinion out there. I call it the brother-in-law effect, where somebody's brother-in-law, somebody's uncle, told them a bunch of negative stuff about the housing market. And I think that it's easy to get caught up in scary headlines. Newspapers are in the business of selling newspapers, and so they're, got flashy headlines and stuff that gets people thinking. But when you zoom out and think about California in particular, and to a certain extent the rest of the nation too, I mean, we're still in a full employment economy that's growing. We've got a 30, 40 year backlog of under building that has meant prices have gone up regardless of what interest rates have done over the last couple of
That's true.
years. And by that standard, as well as the fact that if you look at the kind of back end outcomes for homeowners, I think we got to be reminding folks, like, stop trying to time the market. California's chronically undersupplied, meaning that outside of, wild cards and curveballs in the economy, prices have only ever gone one way over the long term. And you can always take advantage of lower rates if they go down in the future, but you can never jump in the time machine and go back and pay the cheaper price. And I think those are critical kind of fundamentals for folks to understand. I think a little bit of kind of macroeconomics knowledge can go a long way, and just how unlikely it is that we'll see another 3 or 4% interest rate at any point in
Yeah.
the near
Right.
future. And crunching the numbers for folks, right? The increase in price is going to more than cancel out any kind of modest declines in interest rates. You're already paying somebody's mortgage. It's just your landlord's right now too. So I think, and you got to live somewhere. I always get people that send me articles that say, oh, if you buy gold or if you bought Bitcoin and invest and do that, you end up just as good as if you would have bought a house. And people don't actually ever do that. When you look at the Fed's data, the only ones that have accumulated wealth are the people that bought their own home, and then that leads to all the other, positive choices. It's kind of like your health. When you go to the gym, then you eat better, right? And that kind of thing. I think home ownership is that first step on that stuff, and should be more focused on that, I think, than timing the market. But overall, I think we are optimistic, and the worst is behind us. But I think, just get used to low supply and affordability challenges. I think that means consumers probably need our members more than ever. We didn't really talk about
Right.
insurance, but there's all kinds of hurdles to navigate for them. But it also, I think, means that our members really got to rise to that challenge too, and kind of link arms with the consumers and help them, go through these minefields to victory or whatever. And that's probably the recipe for success.
Yeah, and that's a great point also about just ultimately, even compared to stocks or Bitcoin, as you as you mentioned, at least you have got an asset, and it kind of makes sense because you stick around because you live in that asset.
Yeah.
I remember reading an interesting study which says everybody says buy low, sell high. Study after study shows people end up buying high and selling low, just like because of psychology.
Yeah. And you still got to live there. Yeah.
Thank you so much, Jordan. This was very enlightening. Anything else you want to add?
I always joke that the number one best time to buy a house in California was 20 years ago, but second best time is as soon as you can. And I don't think that has been impacted by all these, kind of ebbs and flows that we've seen over the last couple of months and years. So I think keep perspective.
All right. Thank you so much.
Disclaimer. The purpose of this podcast, brought to you by the California Association of Realtors, C.A.R., is to provide general and educational information and opinions from a wide range of perspectives regarding politics, voting, elections, legislative issues, and more. The opinions, beliefs, and views expressed by guests or participants of this podcast are solely their own and do not necessarily reflect the opinions, beliefs, or views of C.A.R., its affiliates, their respective directors, officers, or employees. Reference to any individual or entity does not constitute an endorsement, recommendation, or any other position or opinion regarding that entity or individual by C.A.R. This podcast does not constitute professional advice or services of any kind. This podcast is available for private, non-commercial use only. You may not edit, modify, or redistribute this podcast.